Even when the stock market is doing well and is up, there are always bargains, always undervalued stocks that you can be watching for and looking for. And today we're going to talk about 3 undervalued stocks that really stand out. And at the end of the video, I'm going to look at this little industry and a couple other undervalued stocks that might be interesting to do, but they can be a little risky. So we're going to talk about that all coming up next on Investing Education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that sounds interesting to you, go ahead and hit that subscribe button. So I was reading an article, it was from Barron's, called Stocks Keep Setting Records. Here are 22 undervalued ones with plenty of upside. And it seemed like an interesting article, but I hated the article because it really used one measure, which was this implied upside, or basically looking at what analysts were saying is the potential stock price going forward, and they were looking at that rise in stock price. But when I actually looked and used some value investing measures, which we teach in my courses and stuff, and have a whole course on value investing, where you look at it and say, is this truly undervalued stock? They weren't using that. They were only using this one gauge, which is the potential price, which is okay, but doesn't tell the whole story. In fact, there were some stocks that value investors would say on that list are not value stocks. So in the description below, I have the link to the article. You can take a look at yourself. Barron's might have it under paywall, so if you can't get it, sorry about that. But I sorted through all the nonsense and found 3 that I think really stood out as far as undervalued stocks, and a couple more that might be worth a consideration. So let's take a look at that and apply some of these value principles to the stocks that they were basically recognizing. And really the first thing we're going to look at is price to book. What is the price of the stock compared to its underlying assets, its book value? Very common measure used in value investing. If you're buying something that's below a 3.0, by the way, is something that's considered in value investing a good value. And if you can find something under a price to book under 1.0, that's like an amazing value. So we're going to look at things that are under 3.0, and the closer you get to 1.0 or less, that's even better. That's saying that the price per share, or the price, is really not even covering, you're not even paying a premium for all those underlying assets, so it makes it a good potential value. So let's look at these 3 stocks. So the first one we're going to look at is Activision Blizzard, right? They do video games. You might be familiar with them, the various video games that they do. If we look at who they are, they've got some big brand names, right? Dominant things like World of Warcraft, Call of Duty, Diablo, Candy Crush, Hearthstone, Overwatch, more recent franchise for them. And as you can see, they're very strong in their area, but their stock has fallen in some hard times, or it's been a darling at times, but it's fallen in some hard times. So let's look at Activision Blizzard here. I'm just going to go to Yahoo Finance, and already got them plugged in here, Activision Blizzard. You can see their current price. They're kind of trading near their 52-week low, but we want to look at, I'm going to go under statistics, and I want to look at their price to book value. And if we look at their price to book value, which you'll find right here under, if you go to Yahoo Statistics, you scroll on this little valuation measure, and you can see that their price to book value is right here, and they're at a 2.69. So a very below 3.0 was our gauge for something that's a true, starting to approach more of an undervalued type stock. As far as that 2.69. You can see going back, they were at a 5.0. They were pretty high. They were growth stock doing well, but now they're considered an undervalued stock. And there's other different types of measures you can see out here. You can look at their last 52-week change and their price. They're down 23%, where the overall market, S&P 500 wider market is up almost 28%. So quite a difference between them. They were very much in favor, of course, during the early days of the pandemic. Everybody's on lockdown, so they're playing and subscribing to different games. Like any of those those COVID stocks, where now it's fallen off favor because it's not a COVID reopening stock, like maybe a restaurant might be. So what are we seeing? COVID goes up and down, right? So but there's a strong coming, good potential as far as something that's been beaten down, as far as the stock price would go. They even pay a dividend, which is something nice for something more of a technology company. It's a little dividend. I mean, when we look at it, it's like a 0.47 type dividend, but they do pay a dividend, and their dividend payout ratio, I have a whole video on dividend payout ratio to check out too, by the way, is at 13.95%, which means that they can easily afford and pay out their dividend out of their net income. So that's a nice number to see in there as well for something that's really gone down in value, but is now showing us from a price to book standpoint, a good valuation type of measure. Even as forward or looking price to earnings ratios compared to the broader market at 14.81 looking forward, that's very reasonable for its price relative to its earnings. Again, go back in time, that was trading around at 27%. So the numbers have the price has come down, which might make it a good value. And in the sort of those analysts, we're looking at analyst numbers. Like this is what the Barron's article is doing. It's saying it's at $66 now. Well, 1 year target estimate. This is based on a variety of analysts put together by Yahoo as they aggregate that. That's at 92.47. So 92.47 versus 66. That's what the Barron's article was looking at, is that upside. So Activision Blizzard might be a good opportunity. Something in terms of an amazingly low price to book value is CitiGroup, right? CitiGroup is known for their credit cards and their banks. They've got commercial business with credit cards and retail banking all over the world, the country, and institutional business as well. Very famous for their various commercial banking and different things that they do. So CitiGroup is a big bank, and let's see how they're doing. So I'm going to put in their ticker symbol C, and you can see they're at 62.95 for CitiGroup. Again, near its bottom of its 52-week range, around 57. That 1 year target estimate, 81.74, currently at 63. So again, that's where there's some potential upside, at least is what the analysts are saying who follow CitiGroup. There's many analysts who follow CitiGroup. They're not some small company. They're a big, major, solid player. If we look at their statistics here, and you can see, again, their price to earnings ratio, really low, 7.62, 10.55 even going backwards in time. That's really low as far as the price to earnings ratio. But check out this price to book, 0.66, and it's been undervalued under that 1.0 for some time. I mean, again, you're buying, anything less than 1.0 is in the value world is saying that's an amazing low valuation. Now, if it's something that some company's going to go out of business or it's got some real significant troubles, you need to look closer into this whenever you're looking at any kind of value stock. But that's a good indication that it's something you might want to look at closely. Again, CitiGroup, big bank company. I think they pay a dividend too, and which like banks do, banks pay dividends. And again, their forward-looking dividend rate's about 3.23%. That's a nice, well above average for the S&P 500 average on a dividend. So you can get a nice quarterly dividend paid out at an annual rate of 3.23%, low price to book value, low payout ratio, so they can keep paying that. They got $987 billion in cash. So they're going to be able to pay that dividend and weather any kind of storms that might come up to them as well. So something to consider as far as a big bank. The other thing banks do well is during inflation times, because to fight inflation, governments will raise interest rates. And when interest rates rise, financial institutions, particularly banks, because they can pass on those higher interest rates, and actually gives them a bigger spread for them to play with, versus when interest rates are super low, banks will tend to do well during inflationary periods. So again, I'm not your personal financial advisor. I'm not saying buy CitiGroup. I'm just saying it's something to look at, especially during a potential interest rate rising or inflationary time. But there's other banks out there that might be a stronger consideration. Just Citibank was on that list from Barron's. Again, the link's in the description below, and it was highlighted along with the other 22. I'm highlighting it because there were things in that Barron's list that had price to books of over 5 that were not value stocks, traditional value stocks, but something under 1 is a high target value stock. Again, we're looking for something under 3.0. And the last one here, before I give you the two there's the last one that's a good, strong one to look at, and then there's two at the end here that I'm going to lump together that are kind of like, oh, I'm not so sure about, or something you want to look closely at. So the last one here of the 3 is Global Payments. Globalpayments.com, you can find their link. And they're a payment processing company. What they say, they handle payments and global payments. They have a variety of solutions around payment type processing and different industries they serve, like healthcare, restaurant, retail, all sorts of stuff. Maybe they're suffering because of that restaurant retail area has been suffering, and so they're suffering along with their payment processing along with that. Might be what's going on here. Oops. So if we look at them, Global Payments, and they've got a large variety of customers, from big retailers like H&M, Eurocent, Ordain. But interesting enough, another payments processing company, of course, is PayPal. And so they have a portion where they do business with PayPal, along with Starbucks, banks, different things. Okay, so let's look at their ticker symbol for Global Payments Incorporated. Let's see here, Global. I thought I had their thing, but here we go. GPN. Global Payments Incorporated, right? So You can see they're at 146, up a little bit today. But historically, a 52-week range, 116 to 220. So a little bit more in the middle compared to the other companies. But the one-year target, based on what the analysts are saying, is 190. So that's some of their upside there as far as potential upside going. Let's look at their price to book value. If we look at price to book, they're 1.40, definitely under our 3.0 measure. As far as not below 1.0 like CitiGroup, but it's 1.40. Again, looking back at time. About a little over a year ago, it's about 2.32. So that's come way down as far as, because their price has come down, is a big part of that versus back then when it was maybe trading around $220. Again, higher price to earnings ratio. So this is really more in line. I'm not sure about this trailing price. So the price was really jacked up is what this is telling me, but now it's come down to a more reasonable rate. Even 26 was fairly high, but at least reasonable for a tech company. 13%, that's getting a little bit more reasonable. So a good price to book ratio. Dividend wise, these are some dividend payers, companies with a lot of money in the bank. Here we are at a little dividend, 0.69, little dividend, 0.89 going forward, or excuse me, forward looking at 0.69. So you're not going to get a big dividend payment, payout as far as what you're going to get paid in your dividend. Their payout as far as what they're paying on a net earnings, they're fine there. They're at 26% payout ratio, so they're good there. You want your current ratio to be above 1.0. It is at 1.15, so they can pay their debts. They're not carrying too much debt. 43, I believe that's million there would be there because everything's in millions. So they're 2.35 billion in cash on hand. So they got money in the bank. They can pay their debts. They pay a little dividend. Their stock has suffered. It's down for over the last 52 weeks, almost down 29.86, down almost 30% compared to the broader market, up 27%. So as you can see, that's a little bit, that's a little bit more. You can see where it's come down and made it more in a value range. Remember, value stocks, we're trying to look for stocks that have been really beaten down that might then give us a bigger, margin for upside and also some safety around that too. Oh, I didn't look at Citigroup's performance. Let's pull that up real quick. Down 2.5%, so not down as far. They've come back because of those interest rate rises and potential for inflation. And then over the last 52 weeks compared to the broader market, down 28. So that's what that would be. So I promised you there was two stocks. So those three I think are most interesting to me as far as just something to look closer at. Again, you got to do your own research. But also, another thing that was interesting was in that Barron's article, they had two airline stocks. And I was just a little worried about airline stocks because of what's going on in the airline industry. They have a hard time staffing. Certainly we've got COVID going on. They're having troubles with cancellations that we've seen about. I also feel from the longer term trend, even if vacation and holiday travel comes back, I think their main line of business is their business travel. Business travelers have expense accounts pay more. That's going to be depressed, I think, ongoing forward. As people discover, they can do a lot of stuff through Zoom and video calls versus having to travel somewhere. It'll come back some, but might not come back all the way. So let's look at two airline stocks that they had in the article as we wrap up. All right, in terms of airline stocks, the first one they had was Southwest Airlines, ticker symbol LUV, L-U-V. Been a strong player for a very long time. If we look at over their 5-year chart, you can see they just got so whacked out by this whole COVID back here. You can look back at the COVID where the volume spiked and the price just dropped off the chart because it was taking airlines during the peak in the early days of the pandemic, and that struggled, though it's come back, that struggled going through. They're at $44, let's call it, near that 38 low, high 64. The 1-year target is 57, so there's some upside there as far as that target there. They don't pay a dividend, that's fine. The airlines are not going to be paying dividends because they're just trying to hoard cash and keep cash as best they can to stay alive. Airlines, that's one of the challenges, they're just trying to stay alive. So if we look at their price to book, a historically strong, well-run airline, 2.42, under that 3.0, which is good, but not as low as some of these others here. And again, you've got a little bit more of those other risks around airline stocks, so something to be aware of. And then if we look at their 52-week change, they're only down 4.5% compared to the S&P being well up, of course, but only being down a little bit considering their airline. They're one of the stronger airlines, one of the stronger balance sheet airlines. They have like 16 billion in cash. They have 16 billion in cash, so the strong cash position. They pay their debts. They're famous, as I recall, they're very famous for that Current ratio above 1.0, it's what you're looking for. Above 2.0 means that they can pay their current debts, in the short version of that. And that's a good strong number. Not much total debt out there either, consider how much cash they got with that 16 billion. Again, don't pay a dividend, but that's okay. So historically strong company, strong balance sheet, but beaten down, and that price to book at 2.42 can be very attractive. The other one that they had there was Alaska Airlines. All right, so that was on that list, Alaska Airlines. ALK. Alaska Airlines, a little more niche oriented with Alaska Airlines. They have some routes outside Alaska, but you're going to Alaska. Which, one thing from an airline play is people are looking to travel and travel outdoors. They might be more willing to get on a plane and go to Alaska than, let's say, maybe a major city during a pandemic. They're right around 54.5, the lowest 46 to 74. But big upside, the analysts are seeing big upside up to 76. Going from 54 to 76 is a well over 40% increase as far as getting up there as far as a 1 year target estimate. If you look at their price to book number here, 1.83, again, well below that 3.0, more of a niche type stock, more of a niche type thing. Very reasonable price to earnings ratio here. Again, they're up like 7.6 over the last 52 weeks. So if you're looking for something that's not as beaten down, but it's still got a good price to book, maybe Alaska Airlines are well trailing the broader S&P 500, but not down like 30% like others might be if you're a little more concerned about theirs. If we look at their cash on hand, 3.2 billion, current ratio is not as strong. We want that to be above 1.0. So they're just covering their debts here, but they're not carrying a lot of debt. But their current debt that is coming due, they're kind of just barely covering that. No dividend or anything to be worried about or be enjoying that as far as they would go. So again, airlines, there's a lot more going on that you got to really look at as far as the airline industry. But if we look at all those other three companies, strong companies in their areas that have fallen on, beaten down, their price has gone down, fallen on a little hard times, but they're well-recognized strong companies with Activision Blizzard, CitiGroup, and Global Payments. So those are the kind of companies that value investors look at, and adding in that price to book ratio, if you look at that Barron's article, where they're looking at 22 different ones, use this exercise and look at some of the stocks they might have in that article or some of the stocks that interest you, and look at that price to book. And if you're looking for something that's on sale, undervalued, this is different than a FANG stock, like a Netflix or an Apple or something like that that's just growing. These are stocks that have fallen in hard times. Look at that price to book ratio. All right, I hope this stimulates some thought for you. Use it for educational purposes. Take a look at some stocks. Check out some of my other videos. Look at the description below. Check out the videos from free courses we have. And don't forget to hit that subscribe button. With that, I wish you all the best, and hopefully you can go out and find some really bargain stocks that are undervalued that might be great potential for you in the future.